All right, stay with us, Steve. Our next guest says today's jobs report tells her the labor markets are behaving exactly as they would if we were headed into a recession early next year. And that means there could be discussions within the Fed soon about the danger of going too far with rate hikes. She's Frances Donald, Global Chief Economist at Manulife Investment Management. Frances, welcome. These numbers, I want you to sort of make the case for us here that these numbers taken as a group add up to a higher probability or possibility, shall we say, of a recession next year. What are you seeing?
That's how I see it, Tyler. So I keep hearing this was a good jobs report and that's why stocks jumped. No, this was a bad enough jobs report that it means, indeed, I agree with Steve, the Fed is done and we can celebrate that. So let me be clear, even though I do see a recession ahead, there's still some juice behind some of those risk trades. But look at this job report. We've got a jump in the unemployment rate, a jump in the underemployment rate, temporary help is falling, a great leading indicator for the job market, and we have a massive downward revision, 110,000 fewer jobs than we previously believed. In fact, we've had a downward revision every single month this entire year. This is a labor market that is softening, consistent with a recession early in 2024. And this is what happens. This time is not different. The Fed hikes, and about 18 months to 2 years later, you begin to see it in jobs. There's this view that it's a gentle softening and it's going to stabilize exactly at the level it needs to be. But economies have momentum, and it's very difficult to slow this train once we get to that level. We're not there yet, but we will probably get to a location that looks a lot like a recession.
You mentioned a gentle softening. I'm going to have a gentle pushback, and it would be this. The unemployment rate did go up to 3.8%, but how much of that rise in the unemployment rate might be attributable to the fact that labor force participation went up? There were more people in the market looking for jobs and not just immediately able to find them.
And here's the good news, is that the Fed wants to see this. It says we've had too tight of a labor market, but it also means that labor power is going to be diminishing because these people entered the job market looking for jobs. And as Steve mentioned earlier, they didn't find them as quickly as they would have in the past. So more people wanting jobs is good, but only if they actually get those jobs. People wanting jobs and not having them is not bullish. It's not great for the economy.
Steve, reaction?
No, I could see how if you had a pre-existing belief in a recession before this number came out, this could fit in with your idea here. That's fine. I just wouldn't jump off of that jump in the employment rate number into a saying, oh, this shows the job market weakening. I think this is something that happens, Tyler. The job market was so hot before that figuratively people would, be packing their boxes with their stuff from their old job and never unpack the box, just bring that box right to the new job. We were not seeing any of the normal churn that we saw in the job market where people would go, lose job, spend a little bit of time unemployed, and then find job. It was skipping that middle step there. And so you would expect there to be situations like we've had in this month where you'd have this influx in the workforce. Not everybody would find work. Now, it could be that this is the beginning. There has always been the danger in the soft landing that you pass through the comfortable part and then you get to the tougher part and you keep going down. And the idea, but you've got to do this part first, right? And I just don't think that once you're in that part is the time to ring the alarm bell, because there are still some things that the economy has going for it.
In Frances's defense, I don't think, I don't mean to speak for you, you can speak for yourself, Frances, but she didn't really say that the jump in the unemployment rate was the tell here about it.
Right.
She said that when you take that along with downward revisions for month after month after month, wage growth, et cetera.
I take her point, and she can, just very quickly, Frances, I'll let you go, but
sure.
I take your point that the revisions are a sign of the trend, temporary help sign of the trend, but if you look at the revisions where they were too, they're still not bad numbers.
Absolutely. And this is why context is important. No number should be taken. Even numbers within numbers should not be taken out of context. But we're talking about one of the fastest, most aggressive rate hikes in history. Senior loan officers surveying telling us that credit is contracting by some of the most in history. We're talking about a housing market that is completely frozen outside of new home sales. The context is that almost every single leading indicator tells us things are going to get worse. Is it 2 quarters of negative GDP? Maybe not. Maybe manufacturing recovers just as services is heading lower. But I can't look at a job report like this and say it's inconsistent with the idea of a material slowdown. It is consistent with a Fed that can take a break and stocks that can enjoy a little bit of relief for the time being.